Walk into any coffee shop with Wi-Fi and you'll find him. 3 monitors, energy drink, watching green and red candles like his mortgage depends on it, because it does. Meet Marcus, 28 years old, quit his job 8 months ago to day trade full-time. He's down $47,000. Then there's Jennifer. Same age, same starting capital, same market. She opens her app once a month, takes about 4 minutes, and she's up $64,000. Same money, same time frame. The only difference is Jennifer understood something Marcus still doesn't. And once you see what she saw, you will never look at investing the same way again. My name is Profit Mindset. I've spent years watching people light their money on fire, chasing the dream, while the quiet ones just kept compounding. And I promise you, what I'm about to show you isn't what the trading gurus are selling. If you've ever wondered why your account never seems to grow no matter how many charts you study, hit subscribe, because today we're breaking down the exact $500 per month strategy that mathematically destroys what 90% of active traders will ever achieve. And the best part, it requires you to do almost nothing. Hold on to that. Almost nothing. That's the tell. Here's what you have to understand before any of the rest of this lands. In investing, there is no skill contest. There is only a math contest. And the math has already picked a winner before you even place your first trade. You're not competing against other traders. You're competing against arithmetic that doesn't care how smart you are. Every dollar you invest is either working for you or working against you. No neutral, no parked, no building experience. You're either on the winning side of compound interest or you're paying the toll to play the game. And most people spend their entire investing lives on the wrong side, paying rent to their own impatience. $500 a month into the right strategy is the moment you stop gambling and start compounding. And compounding, unlike you, never has a bad day. It just shows up every morning and works. Day traders know exactly when this switch happens. The question is whether you do. Quick disclaimer, so the lawyers relax. I'm not a financial advisor. This isn't financial advice. This is just years of watching the same people make the same mistakes, while the market quietly pays the ones who do nothing. Let me start with the single most damning number in all of active trading. It comes straight from multiple academic studies, industry data, and the SecZone research. Roughly 90% of day traders lose money. Read that again? 9 out of 10 people who sit down to beat the market by trading actively end up poorer than when they started. That is not bad luck. That is not a skill issue. That is the floor the entire day trading industry is standing on. The dream of quitting your job sold to you by the 10% who got lucky while 90% quietly go broke paying for the lesson. And here's the part that should make you sick. The average day trader underperforms a basic index fund by about 6.5% per year, after you account for fees, taxes, and the spread. That means if the market went up 10%, the average active trader made 3.5%. They did all that work, all that stress, all those hours staring at charts, just to get worse returns than doing literally nothing. But let's put real blood on it, because this is where the gap stops being abstract and starts being something you can feel. Marcus started with $50,000. He'd saved it over 5 years working IT support. He watched YouTube, took a $3,000 course from a guy with a Lamborghini in the thumbnail, and learned all the patterns: head and shoulders, bull flags, RSI divergence. Felt ready. Month 1, he was up $4,200. He posted the screenshot. His family was proud. His friends asked questions. Month 2, he gave back $3,800. Unlucky week, he said. Month 3, down another $5,000. By month 8, Marcus had turned $50,000 into $23,000. He'd traded 847 times. He'd paid $4,100 in fees and commissions. He'd triggered $8,200 in short-term capital gains taxes on the few wins he did have. Marcus isn't stupid. He's not reckless. He followed the rules. He cut his losses. He let his winners run. He did everything the course told him to do. And the market ate him anyway, because Marcus was playing a game where the house edge is baked into every single move. Here's what Marcus paid that nobody told him about. Trading commissions. Even at $0 per trade, he paid spread costs on every entry and exit. Bid-ask spread on 847 trades cost him about $1,700. Short-term capital gains taxes, anything he held under a year got taxed as ordinary income. For Marcus, that's 24%. He paid tax on gains, even while his account was bleeding. Opportunity cost. The $50,000 he started with, if he'd done nothing, would have grown to about $55,000 in the S&P 500 during those same 8 months. He lost $27,000 in actual dollars, and another $5,000 in what he would have made by sitting still. Total damage, $32,000 in 8 months. And Marcus is still convinced he just needs one more pattern, one more indicator, one more screen. Jennifer started the same month as Marcus, same $50,000. But Jennifer did something radical. She opened a brokerage account, bought a single S&P 500 index fund, and then she went back to her life. Once a month, she added $500. Took 4 minutes. She didn't check the price. She didn't read the news. She didn't have an opinion on whether the market was overbought. She just bought the same fund, same day, same amount, every single month. 8 months later, Jennifer's account sits at $64,200. She made $10,200 while Marcus lost $27,000. The gap between them is $37,200. Same market, same starting money. The only difference is Jennifer understood something Marcus is still refusing to see. The market rewards patience and punishes activity. Here's the line I want you to tattoo somewhere. The person who invests $500 a month and does nothing will beat 90% of people who trade daily, not because they're smarter, because they're absent. Let me show you why. Say you invest $500 a month into a low-cost S&P 500 index fund. Historically, the market returns about 10% per year before inflation, around 7% after. Let's use 7% to be conservative. Watch what happens. Year 1, you put in $6,000. It grows to about $6,200. Exciting? No, you made $200. Marcus made that in a single trade on a good day. Year 5, you've contributed $30,000. Your balance is about $35,800. You're up $5,800. Marcus has blown through 3 accounts by now and is back working IT support, this time with $23,000 in credit card debt from covering losses. Year 10, you've put in $60,000. Your account is now worth about $86,700. You've made $26,700 for doing 4 minutes of work per month. Year R Sharwen contributed. Your balance is about $260,000. You've made $140,000. Your money has more than doubled everything you put in. Year 30, $180,000 in contributions. Your account is worth about $566,000. You've made $386,000 in interest alone. You are now closer to retirement than most people will ever get, and you never once looked at a candlestick chart. Here's the part that breaks people's brains. In year 30, your account grows by about $40,000 in that single year, just from compound growth. That's more than 6 years of your $500 monthly contributions happening automatically while you sleep. Your money got a job and works harder than Marcus ever did. I can already hear it. But I know a guy who made $10,000 last month day trading. Okay, fair. Let me tell you what you don't know about that guy. Survivorship bias. For every guy who made $10,000, 9 others lost money and didn't post about it. The data is clear. Over any meaningful time frame, 80 to 90% of day traders lose money or quit. Taxes. That $10,000 gain, if he held those positions less than a year, it's taxed as ordinary income. Depending on his bracket, that's $2,200 to $3,700 gone immediately. The $500 month index investor. Long-term capital gains at 15%, and only when they sell decades later. Fees and spreads. Every trade costs money, even the free ones. By Dask spreads, payment for order flow, platform fees, death by 1,000 cuts. The index fund investor pays about 0.03% per year in expense ratio. It's $15 on a $50,000 account. Total. Emotional cost. This one doesn't show up on a statement, but it's real. Marcus checks his phone 47 times a day. Can't sleep when he's holding overnight positions. He snaps at his girlfriend when a trade goes bad. Jennifer hasn't thought about her account in 3 weeks. Here's the truth underneath all of it. Day trading is not investing. It's a full-time job with no salary, no benefits, and a 90% unemployment rate. And the market doesn't care how many hours you put in. Remember Jennifer's $500 a month? Here's where it gets stupid good. At 7% annual growth, the moment her balance crosses about $85,700, the interest her account throws off in a single year becomes larger than everything she contributes by hand. Sit with that. Below that line, she's the engine. Above it, the engine runs itself, and she's just along for the ride. It takes her about 11 years of $500 a month contributions to hit that number. Marcus, in 11 years of day trading, will statistically have blown up his account twice, taken a break, come back, and be sitting on about $31,000 after fees, taxes, and losses, if he's lucky. The $500 a month investor didn't beat Marcus because she was smarter. She beat him because she understood the one thing everyday trader refuses to accept. You cannot outtrade math. Here it is. The whole thing. The $500 a month plan that beats 90% of active traders? Step 1. Open a brokerage account at Vanguard, Fidelity, or Schwab. Step 2. Buy a low-cost S&P 500 index fund. Vanguard's VU, Fidelity's FXAIX, Schwab's SWPPX. Expense ratio under 0.05%. Step 3. Set up automatic contributions. $500 a month, same day, every month. Step 4. Do not look at it. That's it. 4 steps. The entire strategy. No charts, no indicators, no Discord groups. Number 4. AM futures trading. You just show up once to set it up and then you leave. But what about market timing? What if I buy at the top? Here's the beautiful part. You don't care, because you're buying every single month for the next 10, 20, 30 years. Some months you'll buy high, some months you'll buy low. Over time, it averages out to something called your dollar cost average. And historically, that average beats about 90% of people trying to time it. But what about picking better stocks? What if I find the next Amazon? You won't. And even if you do, you'll probably sell it too early or buy too much in panic when it drops 40%. The S&P 500 is the next Amazon. It's the top 500 companies in America automatically rebalanced. When one company dies, it gets replaced. Own the whole machine. But this sounds boring. It is. Boring wins. Boring is why Jennifer drives a paid-off car and Marcus is still explaining to his parents why he needs to borrow $8,000. Here's the part that matters more than any single number. What changes when you stop trading and start compounding isn't really the balance. It's what the balance does to your nervous system. When you day trade, every notification is a threat. Every red candle feels personal. Every win is temporary, and every loss is a referendum on your intelligence. You are in a constant state of low-grade panic, and your cortisol levels prove it. When you invest $500 a month and walk away, you stop making financial decisions from a crouch. You don't check your account at 9:31 a.m. to see if you're up today. You don't feel your stomach drop when the market pulls back 8%. You just keep buying because you know in 20 years this dip will be invisible on the chart. Scarcity and fear make you small and fast and easy to trick into selling at the bottom. A plan makes you slow, patient, and immune to the noise. Everyday Trading Guru on YouTube runs on one fuel. That fuel is your belief that you're missing out on something. The $500 a month investor already knows the secret. You're not missing out. You're just early. Now here's the uncomfortable part. Yes, 10% of day traders do make money. Some of them make a lot. But let me tell you who they actually are. They're former institutional traders with 15 years of experience and $500,000 in capital. They're algorithmic traders running code you'll never see. They're market makers exploiting bid-ask spreads at microsecond speed. They are not you. They are not Marcus. And they are definitely not the guy selling you the $3,000 course. The ones selling the courses make their money teaching, not trading. Because teaching is more profitable and has no downside risk. If their strategy actually worked, they'd be on a beach, not on YouTube begging for your email. The $500 a month investor doesn't need a course. They need a calendar reminder and the ability to ignore their phone. So be honest with yourself for a second. Right now, today, which one are you? The one staring at charts hoping this trade will be different? Or the one quietly building wealth while the market does the heavy lifting? There's no shame in it. Most people are Marcus. Most people got there honestly.
Oh.
The dream is sold hard, and the truth is sold quietly.
Probably.
But you cannot build wealth on a strategy you refuse to admit is losing. Here's what you actually know if you've been trading for more than 6 months. You've had more losing months than winning months. Your account balance is lower than it was when you started, or barely higher. You've paid more in fees and taxes than you've made in profit. You check your positions more than you check in with your family. You've told yourself just one more quarter at least 4 times. I'm not judging you. I'm saying the market already did. And the market doesn't lie. You might be thinking, but I can't do $500 a month. Okay, fair. Maybe it's $300. Maybe it's $100. Maybe right now it's $50. Here's what matters. The strategy doesn't change. The math is the math. At $300 a month for 30 years at 7%, you end up with about $340,000. At $100 a month, about $113,000. At $50 a month, about $57,000. Every single one of those numbers beats the average day trader's $0 or negative balance after the same 30 years. The door is the door. Walk slower if you have to, but for the love of everything, stop running in circles in the parking lot, pretending you're making progress. Think back to Jennifer and Marcus from the very beginning. Same age, same capital, same market. The only real difference between them was never intelligence. And it was never information. Marcus probably knew more about technical analysis than Jennifer will ever care to learn. The difference was which side of one line they were standing on. Marcus thought the goal was to beat the market. Jennifer understood the goal was to let the market beat inflation. Marcus thought activity equaled progress. Jennifer understood that progress happens in silence while you're doing literally anything else. Marcus is still in the room, still paying tuition to the market, still convinced the next strategy will be the one. Jennifer crossed out of the room 11 years ago and hasn't looked back. Here's the thing to hold on to. That line is not a talent. It's not a gift. It's a decision. And decisions can be made today. You don't have to be brilliant to win this game. You have to be stubborn. You have to be patient through the boring years when nothing seems to happen. You have to refuse to quit during the stretch where day traders are posting screenshots and you're sitting on a balance that grew $160 last month, because that's exactly when it's working. Stop gambling. Start compounding. Let the market do what it's done for 100 years while you go live your actual life. $500 a month? One index fund? 30 years. That's the whole strategy. It's not sexy, and it won't make you rich by Friday. But it will make you wealthier than 90% of the people currently staring at candlestick charts wondering why they're still broke. The math doesn't care about your feelings. It just pays the people who show up and wait. Now go be boring. And in 20 years, send me a thank you note from the account Marcus wishes he still had. This is Profit Mindset. I'm Alex, and I'll see you in the next one.